You know that feeling, right? You made an investment, things didn't quite pan out as hoped, so you sold at a loss. Maybe think you'd buy back in later, soften that tax bill. Sounds like a pretty smart move. Well, today we're diving deep into a rule that can turn that clever maneuver into a real financial head-scratcher. The wash sale rules. Welcome to the deep dive. Today we're pulling back the curtain on wash sales. It's a critical and honestly often misunderstood piece of the tax puzzle for anyone trading stocks or securities. Our mission: to demystify what a wash sale actually is, precisely how it works, and I think most importantly, how you can avoid accidentally stumbling into these regulations, especially when, all you're trying to be is a genuinely savvy investor.
Yeah, and what's truly fascinating here, and what really drives these rules, is the IRS's intent. They want to prevent taxpayers from, let's say, artificially creating losses for tax purposes without actually changing their underlying investment position. It's really about looking past the superficial transaction to the spirit of the law, and that has pretty significant implications for how you strategize your trades.
All right, so let's really get into the nuts and bolts here. At its heart, a wash sale happens when you sell stock or securities at a loss. And then, within a very specific time frame, you basically replace that investment, the core consequence. You effectively kiss that tax deduction for the loss goodbye.
Right, it's disallowed for that year, at least initially.
And that critical time frame, it's tight, just 30 days before or after the sale. That 30-day window is absolutely crucial to remember. I feel like that's where most people get tripped up.
Exactly, and the IRS isn't just looking for a direct one-for-one repurchase of the exact same thing. There are 4 specific actions that'll trigger a wash sale if you do them within that window. First, the obvious one, simply buying substantially identical stock or securities. Second, acquiring substantially identical stock or securities in what's called a fully taxable trade. Third, and this catches people, acquiring a contract or an option to buy substantially identical stock or securities. And fourth, this one's interesting, acquiring substantially identical stock for your IRA or Roth IRA. That last point often surprises people because they think of IRAs as separate.
Wow. Okay, so it's not just my individual brokerage account they're watching. And here's where it gets, well, really interesting. These rules extend beyond just your direct actions, right? Like if you sell at a loss and your spouse, or maybe even a corporation you control, buys substantially identical stock.
Yes, you still have a wash sale. That's a pretty broad net, and it's designed specifically to ensure people don't try to use, family members or controlled entities to kind of sidestep the rules.
That makes sense.
Precisely. The strategic takeaway here is you can't just sell a losing stock today and buy it back tomorrow purely to claim an immediate tax deduction. The IRS has seen that play before, and these rules are designed to discourage those kinds of superficial transactions that don't represent a true economic change in your investment exposure.
Okay, so you can't deduct the loss right away. Is it just gone forever, like vanished into thin air?
Not quite. And this is important. There's a silver lining, or maybe postponing is a better word. It's actually quite a clever mechanism.
Oh, okay. Tell me more.
That's right. The key mechanism here is the basis adjustment. Think of it like this. The disallowed loss isn't permanently gone. Nope. It's actually rolled into the cost of your new substantially identical shares. So let's say you bought new shares for $800 and your disallowed loss was $250. Your new effective cost for tax purposes becomes $1,050. See? $800 plus the $250.
Okay. So the cost basis of the new shares goes up by the amount of the disallowed loss.
Exactly. This effectively defers your tax benefit until you eventually sell those replacement shares. It makes sure you don't get a tax break for just shifting assets around. But it's important to remember that exception. This adjustment does not apply if the new stock is acquired for an IRA or Roth IRA, like we mentioned. In that specific case, the loss is permanently disallowed for deduction purposes.
Gotcha. That's a crucial difference for IRA contributions.
Yeah.
And there's another important deferral thing too, right? Something about the holding period.
Yes, good point. Your holding period for the new stock includes the holding period of the old stock you sold at a loss. That can be incredibly significant when you're thinking about long-term versus short-term capital gains and losses down the line. It could potentially affect your tax rate when you finally do sell those replacement shares.
Okay, let's bring this to life with a simple example. Straight from the IRS guidance, actually. Imagine you buy 100 shares of, say, X stock for $1,000. Later, things don't go well, you sell them for $750, it's a $250 loss. But wait. Within 30 days, maybe just a week later, you buy 100 shares of the same X stock for $800. What happens then?
Okay, in that exact scenario, you cannot deduct that $250 loss on your current tax return. However, you add that disallowed $250 loss to the cost of your new shares, the ones you bought for $800. So your new basis is $1,050. The goal here is clear. It's about deferring the tax benefit until you truly exit the position, making sure you don't get a tax break for just shuffling things around while essentially holding the same investment.
That makes sense. What about another scenario, like company stock? That's pretty common, right? People get stock as bonuses. Say you receive 10 shares of your company's stock as a bonus, which you correctly include in your income. Later, maybe the stock dips, you decide to sell these shares at a loss. What if you then get another bonus award of substantially identical stock, maybe the very next month, so within 30 days of that sale?
Yeah, that loss on the initial sale is also disallowed under the wash sale rule. It's a really key reminder that even employer-provided stock isn't somehow exempt. It can fall squarely under these rules, so timing, again, is everything.
Okay, this naturally leads us to a pretty critical question. What exactly counts as substantially identical stock or securities? That sounds like it could be a bit fuzzy. Is it just the same company name?
It's not always that simple, no. And the IRS often looks past the label to the, let's say, the economic reality of the investment. Generally, ordinarily, stocks of completely different corporations are not substantially identical. That's the starting point.
But like you said, they're looking at the economic reality, so there must be exceptions.
Exactly. There are fascinating exceptions. For instance, think about a corporate reorganization, like a merger or spinoff. The stocks and securities of the predecessor company and the successor company can be considered substantially identical. It's not just about the name on the ticker, but the underlying value and the position you hold.
Okay, so what about things like preferred stock versus common stock or warrants? Where do they fit into this substantially identical picture?
Right. The IRS is always looking for that economic equivalence. So while preferred stock or warrants are typically not seen as identical to a company's common stock, they can be if they meet several criteria, like if the preferred is easily convertible into common stock, has similar voting rights, same dividend restrictions, trades at prices closely tied to the common via the conversion ratio, and it's unrestricted for conversion. Basically, if it walks like a duck and quacks like a duck. If it behaves and functions essentially like the common stock, it's treated as such for wash sale purposes.
So it's basically the same economic exposure.
Pretty much. And for warrants, it's specific. Selling common stock at a loss and then buying warrants for the same corporation's common stock does trigger the wash sale rule. But interestingly, if you sell warrants at a loss and then buy the common stock, it only triggers the rule if the warrants and stock are considered substantially identical under those same economic equivalence tests we just talked about.
Got it. A bit nuanced there.
It is. And it's also worth noting, the rules extend beyond just stock. They cover losses from sales or trades of contracts and options to acquire or sell stock or securities. Think securities futures contracts too. However, crucially, they specifically do not apply to losses from commodity futures contracts and foreign currencies. That's a key distinction for traders in those specific markets.
Okay, good to know. What about short sales? I imagine they aren't immune from this either.
Nope, not immune. The rules apply if you sell short or enter into another short sale of substantially identical stock within that 30-day window, 30 days before or after the date the first short sale is considered complete.
Ah, there's that word again. Complete.
Mm.
That sounds like it has a specific legal or tax meaning here, doesn't it?
It absolutely does, and it's where the nuance really lies for short sales. For wash sale purposes, a short sale is considered complete on the date it was entered into.
Yeah.
If, on that same date, you already own stock or securities identical to those sold short, or you acquire them by then, and you later deliver that existing stock to close the short sale. If you don't own those shares beforehand when you initiate the short, then it's not considered complete until the property is actually delivered to close the sale later on.
Okay. Let's walk through an example to make that crystal clear. Say you buy 100 shares for $1,000 on June 4th. Then, months later, on October 15th, you decide to short 100 shares of the same stock, getting $750. The very next day, October 16th, you buy another 100 shares of that same stock for $750. Then fast forward to November 19th, you close the original short sale using the shares you bought way back on June 4th. What happens to your $250 loss from that short sale transaction?
That $250 loss? Disallowed. The key here is that for wash sale purposes, because you owned identical stock, the June 4th shares, when you entered the short sale on October 15th, That short sale is considered complete on the date it was entered into, October 15th. And since you bought substantially identical stock the very next day, October 16th, which is well within that 30-day window around October 15th, the loss is disallowed. It's a really critical timing aspect for short sellers to understand.
Wow. Okay. That definitely requires paying close attention to dates and holdings.
It does. And just to quickly highlight how broad these rules can sometimes be for folks dealing in very specialized assets, like residual interests in real estate mortgage investment conduits, MMX, the wash sale window actually extends to a full 6 months before or after the sale. 6 months. It just shows how deep these rules can go, even for niche corners of the market. Though, for most individual investors, that 30-day rule is the primary one to focus on.
Okay, now this is where things can get truly granular, right?
Mhm.
Especially if you're not trading in perfectly even blocks of shares. Like, what if you buy more or less substantially identical stock than you initially sold? How do you figure out which specific shares are impacted by the rule? It can't always be a simple one-to-one match.
You're right, it's not always neat. If the numbers don't perfectly align, you sell 100, buy back 50, or sell 100, buy back 150, you have to determine which specific shares the wash sale rules apply to. The way you do this is by matching the shares bought within the window with an equal number of shares sold, starting with the very first shares bought within that 30-day window. First in, first matched.
Okay, let's illustrate this. Another example, maybe using M stock. Let's say you bought 100 shares of M stock for $5,000 way back on September 20th, 2023. Then things aren't looking great. On December 13th, 2023, you buy 50 more identical shares for $2,750. A week later, December 20th, another 25 shares for $1,125. Then finally, on January 3rd, 2024, you sell your original 100 shares for $4,000. That results in a $1,000 loss on those original shares, 5-day cost, 4-day proceeds. What happens now with those December purchases?
Okay, good example. Because you bought a total of 75 shares, that's the 50 plus the 25 within 30 days before the sale of your original 100 shares on Jan 3rd. You cannot deduct the loss attributable to 75 of those original 100 shares. Since the total loss was $1,000 on 100 shares, that's $10 per share. So the loss on 75 shares is $750. That $750 is disallowed. Only the $250 loss on the remaining 25 shares of your original block, the ones not replaced by the December purchases, is potentially deductible in the year of sale.
And what happens to that $750 disallowed loss?
It gets added to the basis of the shares you bought in December. Specifically, it gets allocated proportionally. So the basis of the 50 shares bought on December 13th increases by 2/3 of the disallowed loss, since 50 is 23 of 75, and the basis of the 25 shares bought on December 20th increases by the remaining 1/3. The key insight, again, is that the disallowed loss isn't just lost, it's getting rolled into the cost basis of your new investment, deferring that tax impact until you eventually sell those December shares.
Right, it follows the replacement shares. Okay, another common question I hear. What if you sell multiple blocks of the same stock on the same day? Say you bought shares at different times, so some sales result in a loss and others result in a gain. And then you trigger the wash sale rule on the losing block by buying back soon after. Can you use that disallowed wash sale loss from the losing block to offset the gains you made on the other blocks sold that very same day? It sort of feels like it should net out, doesn't it?
That's a very common thought, but the answer is absolutely not. This is a crucial distinction the IRS makes. A loss that is disallowed because of the wash sale rule on one block of stock cannot be used to reduce any gains you might have realized on other blocks of identical stock sold the very same day. They are treated entirely separately for this purpose.
Okay, no netting allowed there. Let's put that in context. Imagine during 2023, you bought 100 shares of X stock on 3 separate occasions at different prices. Say, block 1 costs $150 at $1 share, block 2 $100 share, block 3 $95 share. Then on December 27, 2023, you sell all 300 shares for $125 each. So clearly you have a loss on that first block, bought at $158, but gains on the other 2 blocks, bought at $195. Then, on January 10, 2024, you buy 250 identical shares of X stock back. What's the consequence?
Right. In that situation, you cannot deduct the loss of $33 per share on your first block, the $158 cost basis block. Why? Because within 30 days after that sale on December 27th, you bought 250 identical shares of X stock back on Jan 10th. And critically, to your earlier question, you cannot use that disallowed loss from block 1 to reduce the gains you realized on the sale of the second and third blocks, even though it all happened on the same day. The IRS is very clear. A wash sale loss stands alone as disallowed and cannot offset other gains in that way.
That's a potential tax surprise if you're not careful.
It certainly can be. It's also worth quickly noting an important, although maybe niche for most listeners, exception. The wash sale rules generally do not apply to a dealer in stock or securities. If the loss is incurred from a transaction made in the ordinary course of their business as a dealer, this carve-out recognizes the different nature of their regular trading activities versus typical investors.
Okay, good clarification. So given all this complexity, the 30-day window, identical securities, basis adjustments, holding periods, multiple blocks, how do you actually report a wash sale to the IRS? It's obviously not something you can just ignore, right? Even if your broker doesn't flag every single instance perfectly for you across all your accounts.
Absolutely not. You can't ignore it. You report wash sale transactions on Form 8949, sales and other dispositions of capital assets. It goes on either Part 1 for short-term or Part 2 for long-term transactions. You'll enter the code WF in column F for adjustments to gain or loss, and then you report the amount of the disallowed loss as a positive number in column G. This adjustment effectively cancels out the loss you might have otherwise calculated for that specific line item.
Okay, Form 8949, code W, and amount in column G. Now sometimes, my broker statement, the Form 1099B, might actually show something about wash sales, right? In box 1G.
Yes, sometimes it will. Opposite 1G on Form 1099B might show the amount of wash sale loss disallowed. This is more common now, especially for what are called covered securities, typically stock bought after 2010, where the broker tracked your basis and the CUSIP numbers are identical and the buy-sell happen in the same account. But here's the absolutely crucial point, and it's one that catches a lot of people off guard. Even if it's not reported there in Box 1G, you still cannot deduct the loss if it resulted from a wash sale according to the rules.
So the ultimate responsibility lies with the taxpayer, not the broker's form.
Precisely. This really raises that important point about personal responsibility in tax matters. The burden is firmly on you, the taxpayer, to know and apply these rules correctly across all your investment accounts, including your spouse's, if applicable, and even IRAs for the repurchase part. You can't just rely solely on what one broker reports on one Form 1099B because they might not know about purchases you made in a different account or an IRA or what your spouse did. Relying only on the form can lead to mistakes.
Wow, what a deep dive. We've truly unpacked the definition of a wash sale, that critical and often overlooked 30-day rule, how those disallowed losses cleverly impact your cost basis in your holding period, which is key for future taxes, and explored the sometimes intricate details of what substantially identical securities really means from the IRS's perspective. It's crystal clear that what seems like a simple trade can have surprisingly complex and honestly far-reaching tax implications.
Yeah, and zooming out for just a moment, understanding wash sales isn't just about avoiding penalties or, catching every tiny detail perfectly. It's really about making truly informed investment decisions. It encourages you to think critically about the timing of your trades and whether you're genuinely changing your investment position, reducing your risk, or maybe just moving money around for a perceived tax benefit that, well, the IRS figured out a long time ago and put rules in place to address.
So what does this all mean for you listening? Perhaps the next time you're considering selling a stock at a loss, maybe take a moment to reflect. Are you truly cutting ties with that investment? Or are you just sort of hitting the reset button with what is essentially the same economic position? And maybe consider what might be the long-term tax cost or even an unexpected benefit of simply waiting just 31 days before jumping back in. Definitely something to think about before your next trade.